Okay, and I think it's time to get started now. And what I'd like to do is to welcome you to the 74th International Atlantic Economic Society Conference. For those of you who I haven't had the pleasure to meet yet, my name is Gary Clayton. I'm a professor of economics at Northern Kentucky University, and I'm also a director of the Best Undergraduate Paper Award that the Society sponsors. I am on the board of editors for the Society, and I'm a former member of the executive committee. Now, the reason I'm here instead of John Virgo is that just a few weeks ago, John Virgo was diagnosed with cancer, brain cancer. And so he has had surgery, and he is in the recovery period now. And while everything seems to be going well, it's going to be lengthy enough, so he won't be here today, of course. So what I'd like to do is tell you a little bit about the International Atlantic Society, because it has been one of the things that John has pretty much dedicated his life to. First of all, the International Atlantic Society was established back in 1973 because John felt there was a very real need for having economists on both sides of the Atlantic, on two continents, discuss the economic issues that were common or separated both. So over the years, that need has grown, if anything. But I've been associated with the Society for a long period of time, and it's been a very rewarding one for me. Now, the purpose of the conference is the purpose of the conference in Montreal is to further exploring the challenges that face the global economic environment while we enjoy one of Canada's largest and most European cities. In this conference today, we're going to have that's better. In this conference today, we're going to have over 400 people on the program, and they're going to represent 35 different countries. So the Society continues its work, and everything seems to be in order. The Society feels that one of its major goals is to provide opportunities for the growth and development of young economists. And this is accomplished in several different ways. They participate in the two major conferences that we have every year. And they participate some of the students participate in the Best Undergraduate competition. And in addition, well-known leaders from around the world have participated in the International IAES Global Exchange, including Nobel laureates and leading government officials. In fact, almost 20% of IAES presidents have been awarded the Nobel Prize. And that's one of the highest of any association, so we're quite proud of that. Now, one of my responsibilities this morning is to just call your attention to a few things on the program and a few things in the packet that you got. So if we would start with the program and take a look at page 6, you will see the list of names of people that are on the organizing sessions for the conference. And in addition to seeing their names, if you another way to find them is there's a note, a flag here on their tag, so you can see who the members of the program committee are. Other items in the program, number 1 is a call for papers for our next two conferences. One of the conferences, these notices are in the back of the program. The first conference is in Vienna, and that's been a very favorite place for the Society to go in the past few years. And the paper submission period for that is open on October 1st and will close on 15th of November of this year. Professor Reinhard Neck is going to be the local program committee chair, and the conference is going to be held at the University of Vienna, which I had the chance to visit when I was a student undergraduate, and it's a wonderful place to go. The 40th anniversary of the IAES will continue starting with the first recognition of it in Vienna to the second continuation of the celebration will be in Philadelphia on October 10 through 13th at the Sonesta Hotel in Philadelphia. So, we hope to see you at both, one or both of those places. Now, a few items I'd like to point out in your conference bag. One is the Clarence C. Morrison Journal Internship. It was established in 2009 to honor the former IAES president and the long-term member of the Board of Editors of the Atlantic Economic Journal. We ask you to support this worthy cause because the internship permits a university student to gain experience in publishing an economic journal. And in your bags, you'll find more information about this program, so I will keep my remarks abbreviated. As far as your donations are concerned, your donations are fully tax deductible, and to say thank you, what the Society is going to do for every $50 donation that the Society receives, that you'll get a $10 gift certificate that you can use on any future IAES program or activity. Now, you'll also find a flyer for the best undergraduate paper for the year 2013. And the dates and rules of participating are specified on that. This program is offered due to the generosity of econsources.com. The Society holds this annual undergraduate competition each year, and the winner of the competition gets a $500 check, but more importantly, they get their paper presented or printed in the Atlantic Economic Journal. And all of the finalists for the paper are going to receive a handsome commemorative plaque, and you've probably seen them already outside in the hall. This year, we've had over 50 students from 9 different countries, and the 50 papers were viewed and evaluated by a panel of 14 judges. So, and the 14 judges came from 10 countries, and there was some overlap between the countries and the students, but basically there are 16 different countries involved in this competition. So the competition has been very well received, and it's really due to the generosity of the universities who sponsor the students to come to the competition, and to the faculty who invariably volunteer to read some of the top papers written around the world every summer. Believe me, it's quite a effort to tackle those 50 things. Well, that's all I have on my brief announcement. One more thing. I see that the Best Undergraduate Paper competition is going to be 4:30 on Saturday. Of course, you're all welcome to come if you would like. It's quite an event. It really is. But other than that, the IAES officers hope that you enjoy the conference and you find it a professionally rewarding experience. And if we can be of any help to you in any way, don't hesitate to ask one of the staff or any of the board members who are around. We'd be glad to help you. And now I want to turn the podium over to Christine Cumming, who was the first vice president of the First Federal Reserve Bank of New York. And she will introduce our head speaker.
Thank you, Peter. Good morning, everyone. It is really my great honor to introduce our speaker, the William S. Vickery Distinguished Address. John Williams, the president of the Federal Reserve Bank of San Francisco and a member of the FOMC, graduate of Stanford, and before that, the London School of Economics and Berkeley, All of that is in your program. I thought what I would just say is, by way of introduction, as I've known John for a long time, he has been, over his nearly two-decade career, not quite 2 decades, been a leading scholar of monetary policy within the Federal Reserve. He has spent considerable time at the Board of Governors as a research economist, providing really very thoughtful scholarship that has helped to form the foundation for a lot of the work that has been going on over the last couple decades. In particular, the whole question of monetary policy decision-making under uncertainty and imperfect information. And I only need say those words, and I think you all understand the enormous relevance of his work in today's world. More recently, of course, John has been serving as the president, but continues to publish as a scholar and is helping to navigate us all through these very difficult times and uncertain times that we are dealing with. So it really is a great privilege for us all to hear him talk about, I guess, in defense of moderation. So it should be very interesting. He'll be taking questions after his talk. And so thank you, John.
Well, thank you, Christine. It's a great honor to be here. This talk I'm going to give today is going to be one of those, I think, the crossroads of economic theory and economic policy making. I'm not going to talk about what the Fed is doing or what the Fed will do or anything like that. This is really a talk about how economic research going back for decades, I think informs policy making and my thinking about policy making in this very uncertain environment. And this line, I guess, which is in my bio, that my research is on monetary policy under uncertainty, that usually gets a laugh in the sense that that was a good preparation for my day job today. So the first comment I'll make is that the opinions I'm expressing today are those of my own, and not those of any of the other members of the FOMC or the Federal Reserve System. So the motivation for this talk is really about, there's a lot of common, these are very uncertain times. These are very challenging times for monetary policy. And there's quite a bit of open debate, public debate, by economists and other commentators, but criticizing the Fed, criticizing the European Central Bank and other central banks around how they're conducting monetary policy. And I'm going to break those into two kind of main themes. And they're both driven by very real concerns and issues about thinking about monetary policy. I'm going to try to tie these themes into what we've learned from economic research on these issues, especially over the last few decades. So one view that you see out there, and Paul Krugman expresses this, but many others express this, is that central banks are not doing their job. For example, the Federal Reserve is tasked with maximum employment and price stability. Maximum employment is generally defined to be an unemployment rate equal to the natural rate. Price stability in the Fed's case is 2% inflation. And so many of these commentators say the Fed, and I will show you some charts, seems to be accepting a very high unemployment for many years, even though inflation is below 2%. And they're saying, well, if you just look at a textbook of presentation of how to do monetary policy, you really clearly you're not doing the right thing, and you should be much more aggressive and bring unemployment back down much faster than we seem to be doing. On the opposite side, you have the comment that the tools that we have, given that we're essentially at the zero lower bound and the Fed funds rate is near zero, it's true of many countries today, and you have to go to unconventional monetary policy tools, which by that I mean asset purchases or QE, or using our forward guidance, using our FOMC statements and communications to try to guide expectations about the future path of policy, that these policies are untested or uncertain or ineffective. These are comments that I'm just saying you hear, and they're prone to unintended consequences. And so the argument there is, given the huge amount of uncertainty about these policy tools and their effects and the potential risks to using them, they shouldn't be used at all or most sparingly. So these are two polar extremes that you hear from prominent economists, and I think represent some serious thought. But what I don't find either of them on their own compelling. And specifically, I think that they ignore the fact that, or they don't take into account, it's explicitly what we've learned from economic research is what you can combine notions of optimal policy with uncertainty. You can actually bring these together into a coherent framework and actually think about policy taking into account the uncertainty. So that's what I'm going to talk about today. And I think just to make another comment is that this idea that the monetary policy has shown signs of what I think of moderation, or some people call timidity or gradualism. This has been seen for decades, so this is not a new experience. Really what it is has been discussed for a long time, I think reflects trying to do the best policy, taking into account the uncertainty that policymakers face in the real world, as opposed to theoretical models. So that's what I'm going to go through in the next few minutes. So just very briefly, these are the most recent FOMC, what we call projections or forecasts. And currently, currently the unemployment rate is 7.8%. But at the time, it was roughly 8.2% or 8.1%. And the black line, which is hard to see here, I guess, in the middle of the dark band is the median forecast of FOMC participants. And what you see is that the unemployment rate starting today at roughly 8% and very gradually getting to about 6.5% at the end of 2015. The blue bands show the range of responses of various FOMC members to the question of where do you expect unemployment to be over the next few years under appropriate monetary policy. And so someone like Paul Krugman looks at this and says 8.2% or 8% unemployment, 7% unemployment, 6.5% unemployment. These were all unacceptably high. You have unemployment way above the full employment level in 2015. You clearly aren't doing your jobs. And then you would point to the fact that, and these are inflation forecasts, which are the median inflation forecast is below 2% for the next few years, and in fact doesn't even get close to 2%, or doesn't reach 2% really until 3 years from now. So if you think about optimal policy, if you think about the textbook of what monetary policy should do, unemployment's too high, inflation's a little too low. A balanced approach would be aggressive action, bringing unemployment down faster and allowing inflation to rise a little bit faster towards 2%, or in fact overshoot it a little bit. So in my talk today, I'm going to go through some of the literature, especially of my career, that's been emphasized by me and many other people and economists on monetary policy. And there's three reasons that this optimal control, this kind of argument that says, just look at that picture, are you satisfied with this picture? If you're not, then do more in this case, isn't that convincing. So one I'm going to talk about is parameter uncertainty. The second is the difficulty of distinguishing between supply and demand shocks. In the monetary policy literature, we call this the natural rate uncertainty. So what's the natural rate of unemployment, as Milton Friedman would call it? But that's a key issue when you're thinking about monetary policy. You want to accommodate supply shocks. You want to perhaps respond to demand shocks. But in the real world, when we see GDP moving, we don't know a priori whether it's demand or supply. And the third argument is really that there are other factors in the economy besides unemployment and inflation that you should care about in terms of doing monetary policy, and I call these monetary frictions. So I'm going to use a really simple toy model because that way I can derive everything analytically and show things, I think, in the cleanest possible way. The nice thing about this is it gives really good answers to about how much these various concerns should affect one's thinking about policy. Obviously, if you're doing a real analysis for policymakers, you want to use a much richer model that has all the details of an open economy today. But still, I think this is pretty helpful. So the stylized model is very simple. The central bank, the Federal Reserve, the Bank of Canada, the European Central Bank, is basically trying to minimize a quadratic loss function. It's a linear quadratic framework. The loss with the curly L is the expected squared inflation rate. So I'm just thinking about an inflation target of 0. You just want to keep inflation near 0, but this could be adapted to a 2% target. It doesn't have any effect. And then you have some concern about the output gap. And the output gap here is the difference between Y, which is output, so GDP, or maybe the unemployment rate. You could think of it different ways, but let's think about GDP. And Z is potential output. So Z is the potential of the economy, or the supply side of the economy. Y is the level of GDP. The output gap is the difference between the two. Lambda measures the relative concern about output variability compared to inflation variability. Now, this is pretty much the textbook model of what central banks tend to focus on. Whether it's in, and also can be founded on microeconomic principles. So the model is really easy. Output Y depends negatively on R, which is the interest rate, the monetary policy tool. Depends on Z, the supply potential output, and U is a demand shock. And I'm going to assume that these are both mean zero IID shocks and all that. So basically, output is negatively related to the interest rate, and it has supply and demand shocks. So the IAES curve. Inflation is a very simple kind of Phillips curve. Inflation depends on the output gap. If output is above potential, it creates inflationary pressures. Inflation goes up, vice versa. And E is an inflation shock, or what's called the literature markup shock. And monetary policy responds to these various shocks. When demand is high, you raise interest rates. When there's inflation is high, or shocks to inflation, you raise interest rates. And it's written down in this very simple equation that says the R depends linearly on these various shocks. Now, what's neat about this toy model is that it actually corresponds exactly to the new Keynesian simple new Keynesian textbook model under certain assumptions. So if you go to Mike Woodford's book or other treatises on monetary policy from the last 10 years, under certain assumptions, actually that model, which is very complex and developed under microeconomic foundations, actually simplifies to this kind of framework, as was shown in a paper by me and Andy Levin some years ago. So I'm not going to go through all the math. I have the math to show I did it, and I have Greek letters to show it's really cool scientific economics. But basically, the basic principles of monetary policy fall right out of this kind of framework. And again, you can make a very complicated model, and you'll get to the same place, but you'll have to run MATLAB programs for weeks. So the first thing is, in this simple model, is that delta is the coefficient that's the response to potential output. In this simple model is you fully accommodate supply shocks. Monetary policy wants output equal potential, so basically in this framework you try to use monetary policy to not push push against a supply shock. You want to create monetary conditions such that output equals potential. So potential output goes up, like a productivity increase, like in the late 90s. You want monetary policy to allow that to happen and output to rise with the supply shock. The second is that in response to demand shocks, and this is assuming you can observe them, is to fully offset a temporary demand shock. This is what I think Olivier Blanchard called the divine coincidence. In these models, if it's a demand shock, you want to completely offset it. If demand is high, you raise interest rates a lot, bringing demand back down to the potential level. And then if you look at the Phillips curve, inflation depends on the output gap, the difference in output and supply, and so you've kept inflation exactly at target, you've kept output exactly at potential, you've done a perfect job. So these models tell you respond really aggressively to demand shocks. And this gets back to this issue that Krugman and others point out, said, wow, theory tells you completely offset demand shocks. We're in a big demand shock, the Fed should be acting very aggressively, or other central banks should be. The final one is the interesting one. This is the one we write monetary papers about because those first two are pretty obvious. And that's a policy trade-off. If you have an inflation shock, like an oil price shock or some other kind of shock to wages or prices, then there's a policy trade-off. Inflation is high, but if you raise interest rates to bring it down, you can make output below potential. So you got to trade off between these two objectives. You can't hit both of them, and you're going to have to, obviously, given a quadratic objective, to be somewhere in between them both. And that equation tells you, you basically weigh them depending on the parameters of the model, and specifically how much you care about output variability. If lambda equals 0, where you don't care about output variability, you're in what was called years ago an inflation nutter. You only care about keeping inflation constant. Then there you would completely offset the inflation shock, keep inflation exactly at target, and let output do whatever it does. Up and down, you don't care. In the real world, central bank like the Fed, we have a balance objectives in my view. We want to balance those two, and so lambda would be not 0, but actually a positive number. You face that trade-off. So I'm going to quickly go through the three issues about why those answers, which if you numerically go through these, and this has been done in many papers over the last 20 years, suggest that the Fed and every central bank should be moving interest rates 5 or 10 times more than they actually do. Instead of moving the funds rate in normal times by 25 basis points in response to some news, you would be moving it meeting by meeting, 50, 75, 100, 150 basis points. And you would be responding very aggressively. But we don't see that. So let's think about why we don't see it historically, and then apply it to the current circumstances. So the first thing is we don't know these models. I just put down a model. I put down a bunch of parameters. I said the optimal policy is to respond by 1 over eta. Presumably, when I was a staff member, my job was to tell Alan Greenspan what eta was, so that he could, the Greek letter eta, so he could then take the inverse of it and then apply it to policy. That's the way I viewed my job. And then there was a realization is that, like, I estimate eta. I'm going to talk about this a little bit. Eta is the slope of the IAES curve. But there's kappa, the slope of the Phillips curve. I estimated eta, and there was this problem. I got an estimate, I'm going to tell you about 0.4, negative 0.4. But there was a big standard error around that. And when my colleagues estimated it, they got a different number, and they got a standard error. And we looked at other models, theories, we got different numbers. So there's a realization that maybe eta isn't a fixed number. It's something that we're doing our best to estimate. So what I'm going to do is apply a Bayesian approach to policymaking. This goes back to Brainerd's famous paper in 1967, but it's been developed by many people. So this is not original at all, but I think it's pretty simple and clear. So the basic idea is you take your objective function, it's quadratic, do what all economists do when they're not quite sure what to do. You take derivatives. That was how everyone got through their comp exams. And you take the derivative, you get your first order conditions. And if you look at this equation, and I'm not going to go painfully through this, but you'll see that there's these kappa squared and eta squareds that appear in these formulas. And so what that means is that, there should be a squared on one of those terms. But what that means is you have squared terms that you're uncertain about. And if you're a Bayesian, you want to know what the expected value of a parameter is. Well, as you know from simple statistics, simple probability theory, the expected value of a squared number depends both on the variance and it depends on the squared value of the number and the variance. This is the sum of the two terms. So what you end up getting in this kind of framework where you're actually saying, I'm not sure what the slopes of these relationships are. There's uncertainty about it. And yet I still need to make a policy decision. I need to tell Alan Greenspan, or today Ben Bernanke, what you should do. Well, what you get is a very simple formula. And the simple formula is given in the bottom, where so gamma beta, got these progressive lenses I have to turn down, is if you knew the parameters, it would be 1 over eta, so eta over eta squared, right? Well, now you have the sigma squared eta. That's your uncertainty about the parameter. It's the square of the standard error of the estimate. So what are you doing here? You're basically being conservative. You're saying, well, I think eta, in this case, is 0.4. I think that's the right thing. But what I'm going to do is I'm going to basically bias the policy to do a little bit less. And why do you do that? Because you've got a positive term in the denominator. Why are you doing that? Because you're basically afraid of a result where the policy has a much larger effect than desired. So if you think about the current context, it's kind of like the story that some people talk about unintended consequences. That the Fed, by doing quantitative easing, might create a lot more inflation than they expect. Now, I'm not going to say I agree or disagree with that view. I'm just saying that's an argument you hear. Well, actually, that's an argument that's exactly the same as saying in this model that maybe kappa or eta are much bigger than you expect. And what the theory tells you is to moderate or attenuate your response because of that uncertainty. And the greater the uncertainty, the more moderation. The same is true for the response to supply shocks, to inflation shocks. And this is a very simple result. It's arithmetic, it's calculus, and it's very general. So the nice thing about this is for all of us people who do empirical macro is that you can actually compute what this, pretty simply in the simple model, but also more general models, you can actually compute what this tells you about how much moderation is appropriate for monetary policy under uncertainty. So let's define the t statistic as the estimate divided by the standard error of the estimate, like we all learned. So t eta and t kappa are the t statistics associated with estimating these parameters. This is a Bayesian approach, but I'm going to call them t statistics. Well, if you take the math I showed you in the last slide and you just do a couple substitutions, you get exactly this formula, which says on the case of gamma b, that's a response to a demand shock, it's proportional to what you would do if you knew everything, but you multiply it by this little attenuation factor. And the attenuation factor depends on the t statistic. So if you have well, I'll give examples, but it's 1 over 1 plus the inverse of the t statistic. And that's the formula to get out of this. So all you have to do, now that I go back to this question, what should policy do to a shock? You have this formula here. So it's the same as you got under optimal control, but it has attenuation, and the attenuation depends on how precise your estimates. It's the same true for the other shock, except some other parameters show up in the formula. So this is just a plot for gamma, and give you simple numbers. If you have a t of 3, you basically attenuate by 20%, a t of 2, by 10% for a t of 3, a t of 2, 20%. If you get down here a t of, down here, you see you're down much greater attenuation, and it's a pretty nonlinear relationship. Similar patterns for the other parameter of the model. Okay, so what does that tell us in the real world? Well, I read through all the papers that I and my colleagues and people the literature on this, about how precise our estimates of these kind of relationships are. And if you read the literature, you tend to find t statistics, say, on the slope of the IAES curve or the Phillips curve, generally around 3 or even higher. And if you go back to my chart, if the t statistic is 3, basically parameter uncertainty is kind of irrelevant. It implies very little attenuation. And this has actually been a challenge to the literature, because in the data, we see that central banks actually show a lot more attenuation. They're basically much more moderate in responses than maybe this would suggest. But I think there's a number of reasons not to take that seriously. Now, I put one of my own papers in there to make sure, or a couple of my own papers to make sure this criticism applied to my own work. And that is, whenever you estimate a model, you go through a lot of pre-estimation filtering and sample selection, specification selection, there's publication biases. So it's not surprising that when you review a literature on the precision of estimates, you're going to get a number that's big. Because all those t statistics were 0.7, they used to show up in the garbage can, now they're just deleted. So I think that you have to be very careful about reading this. I have a paper in the macroannual, NBR macroannual 7 years ago. And we did very careful, took weeks and weeks of analysis in this complex DSGE model. And in the end, parameter uncertainty didn't matter much. But arguably, that's a model that was based on another published model that had gone through years and years of development and probably been fine-tuned to the data quite a bit. So I think you have to be very careful about taking seriously how precise published estimates are. So what I did here is I did something that is totally just go on eViews, run a simple regression. And that is run the regression of the model I showed you using annual data. I actually had to put some auto-regressive residuals to deal with the dynamics, but just ignore that for the moment. And I estimated these two parameters. Eta is 0.4, kappa is 0.125, and the t statistics were roughly 2 on each of those, 1.9 and 2. So I actually think in all the work I've looked at, that's much more realistic. So if you think about what that means, is that it would argue that you get the top line is the one I think you should look at. In a baseline of this model, it suggests that policy should respond about 80%, as much as theory said, just on this parameter uncertainty. Now, if you look at, I want to jump ahead to unconventional policies. There's some recent work trying to figure out how uncertain unconventional policies are, the quantitative easing policies. Mike Kiley at the Board of Governors has a paper on this. There's Baumeister and Benatti have a really nice paper on this, and some work I've done and others. Arguably, it's hard to compare apples to oranges cleanly, But I think based on that literature, I would argue that the t-statistic around the estimates of these quantitative easing policies is probably closer to 1.2. And so in this chart here, I would suggest looking at the second column, not the first column, and thinking about kind of what are the lessons from parameter uncertainty about what policy should do. So 40% attenuation, not 20%. I'm going to skip that. So the next point that comes up a lot in the history of monetary policy, especially Athanasios Orphanides and my work with him, is that a lot of people look at policy should be stabilizing demand or unemployment, but that analysis doesn't reflect the fact that we just don't know what are demand and supply shocks. What you have to do is you have to have a huge staff of economists using very sophisticated methods, carefully looking at the data to try to do your best real-time estimates of what's supply and demand. So in doing that, in this simple example, just to illustrate this, I'm just going to assume that the policymaker doesn't observe the supply and the demand shock, but only observes the sum, observes GDP. So that in this equation, the interest rate depends on U plus Z, which would be the sum of the supply and demand shocks, and responds to that, and it also responds to the inflation shock. And what immediately falls out of this problem is that you're now having to filter. You're having to decide, well, output just seems to be going up by 1%. How much is supply and demand? And statistical theory tells you that what you do is you filter based on the historical variances of these processes. And so that gives you at the bottom here the answer that says you respond 1 over eta, that's the normal policy response. But then you temper that response based on your best guess of how much of it was demand versus supply based on historical variances or the gain, if you think about a Kalman filter. So in thinking about that, I think an important point is what you're really doing here is you're looking at the data, you're coming up with your best estimate of the supply shock, demand shock, filtering out the supply part and responding to the demand. You're actually responding fully to your best estimate of the demand shock, something that Svensson and Woodford have argued, and you can go through the math, and it's pretty easy to show. What you're doing in this framework is, it's not that you're attenuating the response, it's just you're responding to your best, fully to your best estimate. But based on historical mixes, I'm going to talk about that, a lot of shocks are actually supply, not demand. And I'll just mention a lot of work that I've done with Athanasios Orphanides. We've argued in a more general context of different models that you really do want to be careful about this filtering, and you want to respond less to output than because of these issues. So I'm going to talk a little bit about the evidence of the past 5 years and thinking about how this plays out. And I'll give you, in terms of the unemployment rate, I think we've seen quite a bit of research, debate about to what extent are we in a new normal, what extent of the events of the last 5 years caused unemployment, structural unemployment to rise. That's something that is pretty controversial, there's a lot of research on. I think that even if you look at the estimates from the Congressional Budget Office, my colleagues at the New York Fed and San Francisco Fed, and other economists, basically the view is that a typical estimate of the natural rate of unemployment is today is about 6%, which is about 1.2 percentage points above what it was estimated before the recession. At the time I wrote this, unemployment was about 3.4% above where it was before the recession. So it argues that roughly a gain of 1/3 has been applied there. But I'm going to turn to the GDP, which I think is consistent with the historical experience, which is very reasonable. You look at GDP, it's actually quite striking. So the blue line here at the top is the CBO, the Congressional Budget Office's estimate of potential GDP as of August 2007. The red line is their current estimate as of August 2012. The whatever black line at the bottom is actual real GDP as of the most current data. If you look at this, if you had taken the CBO's potential estimate from 2007, if we had not adjusted that, they had not adjusted that, if they had not reviewed and reanalyzed and reconsidered all this, you would think the output gap is a distance between the blue and the black line. These are in trillions of dollars. But given the revisions, basically this filtering process I talked about, you can see that the red line is about halfway in between. So this is a really good example of this filtering process in play. Roughly half of the decline roughly half of the output gap between the old potential GDP and current GDP is actually explained by a reduction in potential GDP estimates in this case. So again, that would be like a gain of a half. So it's really important in doing monetary policy to get this potential GDP or the natural rate right, and you also have to be, and you can see in this case, if you didn't do that adjustment, you would think the output gap is, I think, over 12% today. And this comes up quite a bit in comments about the Fed's policy. People say we should be doing nominal GDP targeting, which would add inflation to this line, but it would put us on this upper line. And some people have argued we have a 13 or 15% output gap today. Well, based on the CBO's estimates, which are similar to ours at San Francisco, I think that's just a gross exaggeration. Lastly, I'll just mention, I want to leave lots of time for discussion, so I'll just mention monetary frictions. Economic theory tells you that there are optimal monetary, if you have transactions needs for money, if you have to prepay wage bills for workers, interest rates actually end up showing up in this model in different ways, and that it shows up in the loss function, that the central bank actually should, in theory, be concerned somewhat by not only output and output and inflation variation, but also interest rate variation. And this has been studied quite a bit in the research, and I'll give you, the theory is very simple. It basically gives you attenuation, just like parameter uncertainty. The math goes through the same. And in fact, if you look at a paper that, my macroannual paper, we actually estimated in a micro-founded DSGE model how big this effect is. How big should tau be, the objective on, or implicitly, how much we should care about interest rate variability based on these concerns. We actually got the answer is that reduces the optimal response to shocks by about a half. So these channels could be pretty important in normal times, arguing that, again, for moderation in policy. I think an open question today is that we're at the zero interest rate, essentially, today and for many years. These theories basically tell you optimal policy for these concerns, monetary frictions concerns, would argue for a zero interest rate. So I'm not sure if this channel is as important today as it would be normally. This would actually argue today that maybe we shouldn't be attenuating as much as we've had in the past. That's the math. It's too complicated, but it's the same thing. This basically makes, I go through the analysis carefully, that just makes the point in pretty much any model, if you add any of these monetary frictions, these also argue to attenuate the response to shocks in the way that we've seen historically. So I'm going to conclude and make some general comments about how, again, how research, I think, is incredibly important in the policy world. One of the challenges for the last 15 years when people study monetary policy is try to understand, is what the Fed's been doing in the past or what other central banks have been doing, is it actually a good policy or not? That gets around the Taylor rule and variations on the Taylor rule. And from the very beginning in the 1990s, my colleague Glenn Rudebush, my co-authors and I and many others quickly saw that a big question mark is, wow, in our models, in theory, monetary policy should be acting much more aggressively. They should be responding, especially to demand shocks, far more aggressively than we've ever seen. And it was a puzzle. In Glenn's paper, is the Fed too timid in Restat? I think posed that question. His answer, I think, was yes. The only way you could justify it is if there was this very strong aversion to moving interest rates, which is, from an economic theory point, wasn't convincing. We were all convinced that there were other reasons, real reasons, uncertainty, issues, the kind of issues I've talked about today. But these actually require a lot of work in terms of measuring and coming up with the evidence on. And so one of the points of this talk and the work that's being done, which in this very simple model, but is being done in much more complicated models, is try to come up with realistic metrics of, what does uncertainty teach us about or tell us about what should monetary policy do. And I gave us some examples in this model that in normal times, uncertainty probably tells you to attenuate the policy or moderate policy a little bit, but not a lot. In the current situation, probably argues for considerably more caution, gradualism than you normally would see. But importantly, it does not. It never says don't do anything. It says do the policy reaction, but pare it back somewhat, and maybe by as much as half, but still take strong action. And finally, a point that I think is very important is that's been emphasized in the literature about the 1970s. It's absolutely critical that we take seriously this issue of distinguishing between supply and demand shocks, doing the very best we can. The people at the Fed, people at other central banks now put an enormous amount of time and effort on that, as do academic economists, and we take that very seriously. And I think that's a big lesson of the 70s, is not to try to stabilize output at some exogenous level, but to, based on all of our economic theories, insights, and data, to do the best job we can in measuring these things and then applying policy appropriately. And then finally, I'll just say there are a lot of caveats to all of this. This is a very simple framework. Obviously, the quantitative work that goes into thinking about these issues involves much more complicated models, involves issues about, is this really Bayesian? Is this uncertainty like this, or is it more like Knightian uncertainty, where it's very hard to know what could happen? So for example, during the financial crisis, we weren't talking about sigma squared equals 3. We were talking about we have no idea what sigma squared is. How do you make policy in those environments? I think that's not really the right frame. I'm not using the framework that I would use for that. That's really a situation where you're dealing with huge downside risks and tail risks. But I am talking about normal, well, what is now normal monetary policy, and thinking about macroeconomic objectives and dealing with a very uncertain world, which is what we always have had and what we definitely will have for as long as we live. But I'm happy to take any questions from people. Next 15 minutes, I guess.
So this is not my area of specialty, so don't forget how naive my question is going to be. But essentially, there's the idea that we can accelerate the economy by lowering interest rates. And that's what the Fed has been doing. Lowering the federal funds rate, buying toxic assets, and giving banks cash. But the assumption is based on the idea that banks would lend their excess reserves, but they seem to be quite reluctant to do. So from my very naive perspective, it seems like we're pressing the accelerator, but the cars are neutral. Shouldn't the Fed focus more on how much excess reserve banks already have on their balance sheet? Because the fear is that we're going to move from a very stagnant economy to a very inflationary economy once all these excess reserves start flooding the market.
So I think that this question comes up a lot. I think that, in thinking about the Fed's policies in particular, I think that the focus really is not that, from what we're trying to accomplish, is not about creating excess reserves. Creating excess reserves is a effect of our policies. Really what we're doing is trying to buy longer-term assets, mortgage-backed securities and treasuries, drive down interest rates, get people to buy houses, get people to buy cars, get the economy going in the way that I talked about. The fact that in doing this, we're not sterilizing, so as we buy more assets, we're increasing reserves, and those reserves, as you said, are not kind of getting out and immediately gain lent. I think that, so the fact that reserves are going up is just a mathematic effect of our balance sheet growing on one side, and that's how we're paying for it. In terms of why the reserves aren't being lent, why the money multiplier isn't working the way that it does in textbooks, I think that really is driven by the state of the economy. This is still a pretty weak economy, growing at 1.5–2%. Banks have tons of liquidity. Interest rates are very low, but the economy, demand for loans, especially from qualified borrowers, people with good credit and some collateral, just isn't there. So I don't see the fact that the reserves aren't getting lent as being a fundamental problem. I think it's just a reflection of economic conditions more generally. But in terms of effectiveness, I do think that I think these policies do work. I think the research on that shows that they work. They aren't a panacea. And in terms of reducing reserves, we do have a plan for reducing reserves once the economy is when it's appropriate given the state of the economy. But.
Yeah, I have a minor question. When you go back to your these statistics that you are using to substitute for the ratio, how would you deal with the idea that once that these statistics is below whatever 1.96, 1.6, then the significance of the parameter in the dichotomous test hypothesis is zero. So you have a non-continuous substitution function to use the moderation policy.
Excuse me, John. Could I interrupt for a second? We have a microphone in the class room, and if you could repeat your question,
I will repeat the question.
Sarah, it might help people in the back. I can hear your question quite fine, but.
Yes, can briefly repeat my question. Econometrically speaking, the substitution that we saw in the formula of the t-statistics as eta divided by the standard error, because we interpret the t-statistics as a diagnosis of a parameter that dichotomously is significantly different or not different from zero, should give us a non-continuous substitution or a threshold below which we cannot take that parameter that implies that t-statistics as a relevant parameter to be used for policy prescription. So how would you deal with this question is my question.
So it's a great question. I'm glad you asked it. In the actual paper behind this is something I discuss. So I'm thinking about this as a Bayesian policymaker. So if I'm interpreting your question correctly, you're kind of asking, there's this issue about classical tests. And this actually comes up in the policy world a lot. And one of the things when you're in the policy world, when you're writing, if you're a researcher, you're writing a paper, obviously people are going to look at classical tests. That's what we do, hypothesis tests and things. But when you're a policymaker, especially what I'm describing as a Bayesian policymaker who's minimizing or maximizing some function where you're integrating over all the uncertainties that you face, you don't care directly about classical tests. So the question of, is this t-statistic significant at the 5% level, 10% level, is on its own irrelevant. What you do have is this continuous function, which says as the t-statistic in this case, I should plot it because it's a continuous function. Only when the t-statistic gets all the way to zero do you stop using this policy instrument. Now, that's the Bayesian approach. There's a lot of assumptions behind that I actually have a well-defined prior and all of that. But in the policy world, classical tests just aren't the right way to think about this. In terms of these decision-making, in terms of these decisions. I mean, clearly you have a nonlinear function as opposed to a step function.
Hi. Okay, now it works. My question is, I think your response to Krugman is that in this great world of uncertainty, a gradual, a more attenuated response is appropriate. So, but the QE announcements are pretty big. These programs are pretty big. So my question is, what is the trade-off between a more moderate response? Take, for instance, Bank of Japan, we buy a little bit more here, a little bit more there, versus those big announcements on big programs. What is the trade-off that the Fed considers here?
So you're testing my approach today, which was to talk about economics and have lots of Greek letters, and not talk about especially the Fed versus the Bank of Japan. Which is not a subject that's gone well for Fed policymakers. Going back to the question, though, and thinking about the reaction function, I think that the big change for what the Fed is doing, in my view, again, now you got to remember this is me speaking for myself, is we have moved our policy actions in terms of QE from big slugs of QE, you know, announcement of like 600 billion over so many months, and a big announcement with a fixed amount over a fixed period of time. We've gone to what I think of as more in this reaction function space, where the announcement was big, sure. I mean, the fact that we went to this, but the idea of this is that the amount of purchases will depend critically on the economic conditions, the economic outlook, and it will be adjusted appropriately based on the needs of the economy, but also what we learn about the efficacy and negative consequences of these policies. So I think that the FOMC statement from September represents a movement, in my view, more to this kind of reaction function that's adjusting based on changes in conditions and away from this, let's make a big announcement. I'll go back to QE1, though. In the middle of the crisis, this was announced first in late 2008 and modified early 2009. You know, again, stepping away from the Bayesian framework, when you're in the middle of a crisis and panic, you know, you could be in a situation where naivety and uncertainty or other concerns are the predominant ones, and so taking a very big, bold action is exactly the right thing in those circumstances. Today, I think we're not in that situation. We're more in the objective of the standard macro objectives, and therefore, you know, thinking about from the approach that I'm describing, I think is more relevant. Obviously, one thing I'll just mention is there are risks to these outlooks. I didn't really talk about that, but you know, in a full analysis of policy, you don't just look at what you expect the economy to do, but you obviously, as a Bayesian, are going to integrate over all the possible things, including the fiscal cliff in the US, European situation. I mean, in the real world, this is just a much richer environment, and you have to take into account far more factors than my little toy model.
Just one more question.
Oh, yeah, he was...
I was just wondering sort of where does, let's say, fiscal policy comes in this story. If you look to the ECB, Frankfurt, their explicit mandate is to look at prices, price stability, not so much as looking to unemployment. Well, clearly right now it's not going so well that, you know, the fiscal players, the government should kind of fix that problem. The Fed has a different mandate, but can you, let's say, can you completely tell this story without, let's say, the fiscal parameters? Or the government is also probably looking at the output gap. Can you completely separate those things?
Well, you know, obviously in a richer model, I agree completely that fiscal policy in the U.S., we have a federal system, so all the way from the local government to the federal government is a big factor, maybe in my little U and E shocks or things like that, a big factor in the model. In a real careful analysis, you would include all of those factors. They also affect the supply side of the economy too, through taxes and regulations. So these are important parts of the economic landscape. What I'm doing here is taking those as given and basically optimizing given that. Now, in theory, cooperative equilibrium would be better, where fiscal and monetary policy were designed together to optimize the social welfare. But you know, there are great benefits to independence in central banking, as you know, and having, you know, basically having the fiscal authority do whatever they're doing, and having the monetary authority then aim on focus on their targets. I think is in a sense of having the ability of the independent action has huge benefits. But I agree with your basic point. Is that fiscal policy, especially today, and especially in Europe, is a huge consideration.
John, thank you so much for this presentation. I'm sure the audience will agree with me that we can really see the link between your scholarship and your role as a policymaker, and also as a person who explains monetary policy to the world. So I hope you will all join me in a round of applause for John. I would also like to present to John, on behalf of the International Atlantic Economic Society, this lovely memorial for today's presentation, naming you a Distinguished Associate of the Society. So thank you, John.
Thank you.
I think so. And that ends our session. So we'll see you